Hello, everyone, and welcome to Startup Investing. We have today with us Paul Singh, and just to give you all a quick introduction of what Onevest is, it's basically a startup investing site where we connect early stage startups with accredited investors. We've been able to build the one of the, or if the largest entrepreneurial network in the world with over 50,000 founders registered, and then as well 15,000 investors as well that are registered on our network. And this is thanks to, for example, our sister site, cofounderslab.com, which helps to provide a service to do matchmaking between entrepreneurs, which helps Onevest really capture in its ecosystem companies at the formation stage. We are, in essence, a curated marketplace where we curate all the startups that apply. Only between 2 to 4% of the startups that apply actually make it to be listed on the platform. And then also every investor that comes to the site needs to apply as well and verified by one of the staff members in our investor relations team. So with that being said, we've been very lucky to be in operations since 2010. We've been pushing the regulatory landscape as well with all the Jobs Act, this new law that is changing the way startups are getting access to financing, and also how and which investors will be able to invest in startup companies. And we've been recognized by some of the largest media outlets as well. We've been very, very lucky in this regard. Myself, I'm going to be your host today. I am one of the co-founders of Onevest, and then as well the CEO. Just really quickly, my background is in law. I am a recovering lawyer, as I would say, still seeking therapy, and I was very honored or very lucky to be part of one of the biggest investment arbitration cases in history with 113 billion at stake. I've also been guest lecturing, as I love to help out people that are about to jump into the entrepreneurial ecosystem or that are already involved in it, and then some other recognitions which I have been very grateful for receiving. As a quick disclaimer, because every I would say every webinar needs a disclaimer. We're not a broker dealer, Onevest. In fact, we have a great partner that helps in brokeraging the transactions. And then as well, we don't provide any type of investment advice. So for this, you would have your lawyer, your accountant, or your financial advisor providing some support in this area. So just really quickly about today on the agenda, we're going to review very quickly how Onevest works. Also, Paul Singh, who is already on the line, and we are honored to have him today with us. He's going to be sharing insights on startup investing. And then we're going to be having a live Q&A in which you're going to be able to ask any questions via the GoToWebinar control panel that you have. There you have the question section where you just type in the question. We will be receiving it on our end, and one of our staff members will be reading it out loud to us. So then we will be wrapping up, and we will have some closing remarks. So with that being said, how Onevest works really quickly. The way we operate is we source the deals from some of the top programs in the US. Right now, we have over 200 partners that are helping us in such referrals. And as mentioned, we heavily curate the process. Only between 2 to 4% make it. And we do provide business due diligence and legal due diligence before the company is actually live on the platform. There's also escrow accounts with minimum investment goals that need to be met before the money is actually released to the startup. And if the company is not able to meet the minimum goals, then the money on that escrow account is returned to the investors. So the way it works for investors, basically it's very easy. You will be creating your profile, then you will be picking the startup that you feel excited or thrilled about, and then after the paperwork has been completed and you've clicked on the investment button, then you will be able to actually go ahead and make the wire, no, to the escrow account. Sorry, guys, I was playing with my pen and I didn't realize that I had here the video in front of me. So sorry for that distraction. So with that being said, some of the success cases that we've had on the platform, which I'm particularly excited about sharing with you all, could be Pristine. They raised 750,000 on the site, and then not even 4 months after, they raised a Series A round with over $5 million in financing. They were essentially hands-free telemedicine that is built on Google Glass. Another case, to give you a good sense of the type of startups that we have on the site, could be SumXR. They closed a $1.5 million round, and they are essentially they provide essentially on their energy drinks a time release energy beats that help to provide the caffeine. So it's a pretty amazing what they built. They are one of the biggest selling energy drinks in Whole Foods, and we are very, very proud that they came and they closed that round with Onevest. So with that being said, I would like to now move to the next section, which is Paul Singh. He's already here with us. And I would like to make a quick introduction. I'm actually honored to have Paul Singh. I'm a big fan of his. He has invested in over 100 companies. He has co-founded several companies. He has done 3 exits, which is very difficult in the startup world because only really 1 out of 10 are a success story. He was a previous partner in 500 startups. And then also right now, he is the founder and CEO of Disruption Corporation, which provides research and investment in the private market. So without further ado, Paul, whenever you're ready, the floor is yours. And I'm very excited about what you're here to speak about startup investing.
Great. Well, thank you for having me, Alejandro. Just as a quick tech check, I assume you guys can see me and you can see my slides now. So I'm honored to be here as well. I'm actually based in very cold and snowy Washington, D.C., which is actually pretty rare. It's usually pretty normal here. But anyway, I'm glad to be here. So before I jump into the presentation, the thing is, like, when you're looking to raise money, the interesting thing is that everybody has all sorts of advice on what your pitch deck should look like, and what you should say or how you can meet investors and things like that. And sort of the angle that I want to look at is from, or share with you, is the angle from the investor's mind. And so 3 big topics that we're going to kind of power through today. The first is I want to explain to you how I see the world having changed for startups. Or how startups have changed. The second is I'm going to talk to you about how the business of venture capital has changed. And then the third thing is maybe give you some tactical tips on how to stand out of the crowd. Whether you're raising money directly from angels, over a coffee table or through platforms like Onevest. The interesting thing to keep in mind is that a lot of these tools or these tactics work in real life and online. So just real quick, professional background for me. I was, I guess my last real job was at America Online, I suppose about 15 years ago now. And after that, I just sort of stumbled my way into entrepreneurship and bootstrapped a couple companies. Most of them failed, to be honest with you, but I was fortunate enough to have an exit in 2004 and another one in 2009. I started investing as an angel in 2009, which for most of you, you'll remember that 2009 here in the United States was an awful year. The market was crashing and the world was falling apart. But I learned a lot and fortunately made a few good investments there. In 2010, I met my partner Dave McClure and became an early partner at 500 Startups with Dave. And then fast forward a couple years, invested in hundreds of companies, and then in 2013 decided to pull out of 500 Startups and start Disruption Corporation. And so anyway, that'll become more clear what we do there. But the point is, I still do a lot of investing, but I also do a lot of research. And if you look at what we really do, that is the core. We provide third-party research and asset management for investors in the private market. One of the things I'm going to say as sort of a caveat is that a lot of the ideas that you're going to hear in the deck as we go forward, are things that I've picked up along the way. So I just want to kind of say right up front that, I think we all stand on the shoulders of giants here. And so if you are looking for books that might have influenced me and that might even be useful for you, I would suggest some of the books on this particular slide. But then just diving right into it. You'll have to pardon the cliche that early stage startups have already changed. Everybody, it always pains me when people are like, oh, companies are changing or whatever. The fact is they changed already. And there's a couple key things that have happened that are important to recognize. The first is that the startup costs are lower than ever. And the best way I can explain this to you is to explain what it was like to start a company 15 years ago. For most of you that are building things online, today you're probably familiar with the concept of Amazon Web Services or Rackspace Cloud. And in many ways, when you want to start something, you can actually start a server in 2 minutes, right? So you can actually have a website in a half hour or an hour. And I know I'm going to sound like an old fart here, but the thing is you have to understand that 15 years ago, you had to buy a server. These were, $2,000 to $3,000 pieces of equipment. You had to go find a data center, believe it or not, which are these big buildings that are ice cold, and you have to go put the server in there. And then you would, believe it or not, I'm not exaggerating, you would connect the back of that server to the internet via an Ethernet cable. The way to really think about this is that, if it used to cost $1 million to start a business in 6 months to start a business in 2000, today, frankly, you could probably do it for less than $10,000 to start. And you could probably get, for most web-focused companies, you could probably get an initial prototype out and deployed within about 2 to 3 days, if not sooner. So the interesting thing here to understand is that startup costs are lower than ever, but scaling still costs money. In fact, scaling a business is getting more and more expensive. Let me come back to this in a minute here, but again, I'm just going to give you the high level of how investors see the startup world changing. It is cheaper than ever to start. If you're trying to pitch an idea, there are going to be a lot of questions about why you can't get past that initial prototype. The second big change that's happened over the last 5 years or so that I've been investing is that the web is getting bigger and the world is getting smaller. And the best way to really think about that is that 5 years ago, 10 years ago, 15 years ago, if you really think about it, the first monetizable large internet audience was inside the United States, right? So in other words, if you wanted to sell something through the internet, you probably focused on the American market because the market had credit cards, we were comfortable buying online, things like that. So that's good for America, I suppose, but what's good for the rest of the world now is that we're seeing the internet penetrate further and further into other countries. And what that's really doing is it's exposing and enabling more people outside the country to not only start their own thing, because remember, it's still cheap to start a company, but also now they can reach customers everywhere else. So the best way to really think about this is that you as founders are no longer competing with the smartest people within your city or your town, but rather you're competing with all of your competitors globally. And I think it's important. I don't mean to scare you into that by saying that, but it's important that you recognize that as founders, is that you're being compared on a global level now, not on a regional or local level anymore. Third big change is that traction is a new intellectual property. And what I mean by that is that for most tech companies, the concept of intellectual property isn't that important in the early days. So what this really means tactically is that in the earliest days as founders and entrepreneurs, you should not be really thinking about patents too much. And I say this not being an attorney, that sort of thing, but I just say that the point is that in the earliest days, your job is to get a few people using whatever it is that you're building on a repeatable basis. And that traction is then your intellectual property. The way that you actually scale and learn how to grow your business, that is your intellectual property. Two very large examples to think about is Facebook, right? Let's think about Facebook first. I mean, and I know you guys know this, but let me just say it out loud. is that Facebook today, I believe, is understood to have about 1 billion people logging into it at least monthly, and something like 700 million people logging into it at least once weekly. Now, with staggering numbers like that, with traction like that, whenever I see a pitch for somebody that's trying to start a new social network, you have to understand I kind of have to shut the door. It may not be fair, it may not be nice, but the thing is, how do you actually get that traction? So that is your intellectual property. The other thing to really think about is if you look at Uber, the car sharing or driver service anyway. Interesting thing about Uber is that you look at how fast they're growing, how many new drivers are coming online, how many people are in an Uber car every second of every day. I mean, Uber's been releasing these numbers. The point is, traction is what matters, right? And you guys as entrepreneurs, your job is to do the minimum amount of work necessary to get traction, and that's key. That will become your intellectual property. The fourth big change is that capital is increasingly commoditized, and this is really, I think, when people think about when historians look back at the last 5 years, I think what they're going to really think about is they're going to call that sort of time the rise of the angels. And that's because, remember, now that the cost to start something is getting lower, now your friend or that angel investor down the street who can write a $25,000 check, that's much more meaningful for you, right? So if you remember 15 years ago, it cost you $1 million to start. If you really wanted to get funding at that level, you'd have to go find somebody that had $1 million, and that's hard. That's really hard. But as the costs to start get lower and things like that, now angels are coming. And that's why I call this sort of the rise of the angels. It may or may not feel this way to you as entrepreneurs, but today it is easier than ever to raise your first 500,000, maybe even your first $1 million. Easier than ever. I didn't say it was easy. It's just easier than ever. Also, it's easier than ever to raise your last big money. It might be 20, 30, or $50 million. That's easier than ever. Not easy, but easier than ever. So that's good. That's good news. And we're going to talk near the end about how you can step out of the noise to win that money. So underneath that, capital being commoditized, the new reality is that money follows founders, right? And this is, just like we saw the rise of the angels, I think we're seeing the rise of the entrepreneurs as well. So this just means that, a lot of founders think that if they just show up in Silicon Valley, that things will just happen. The thing is, you end up getting lost in the mix, that sort of thing. But more and more angels are now popping up in different cities, and then you've got platforms like Onevest and AngelList and all these other things. But money is following founders, and that's good. And again, near the end of this, we're going to talk about how you can stand out of the crowd. I think the biggest change in the startup world is that signals are now everywhere. The best way to kind of really think about that, and really just say, is that transparency is everywhere. The best way to kind of explain that is to say that, a few years ago, I remember when I was looking at my first few deals, frankly, I was just looking at the deck, whatever the founder would put in front of me, whatever the entrepreneur would put in front of me. And many times I didn't know where to ask questions. How do I know that this founder is legit and that they're a subject matter expert, things like that. So the point is, though, is that today, because of social networks and all the data that's available out there, and how easy it is even for venture capitalists like me to build tools, there's a lot of new transparency that I can take advantage of to make better decisions. The best way for me to describe this is to start by giving you an example of Wall Street. So for those of you that might be dialing in from outside the United States, just a quick refresher, Wall Street is our sort of financial center here in the United States. I usually would ask people what these pictures are, but considering I can't see any of you, I won't ask that. But what I'll tell you is, remember, we're talking about in the context of the public market, right? Wall Street. The fact of the matter is that transparency is everywhere. Now, these pictures, they look like they're old, they look like they're boring, but these are pictures of Walmart parking lots. Walmart is a big box store, one of the biggest employers in the United States. Walmart is interesting because they're publicly traded, and the thing to kind of think about is UBS. They're they're a huge bank, international bank. And the interesting thing is that UBS wants to know whether or not they should buy or sell Walmart stock. So not only do they talk to Walmart customers, but they talk to Walmart, other Walmart investors. They talk to Walmart employees. They do a lot of analysis on whether or not they should do the deal. But one of the most interesting things they do, that I think is interesting anyway, is that they actually pay a satellite provider, a satellite operator, like satellites up in space. They pay them to take pictures of every Walmart parking lot every hour of every day. And the reason they do that is because they can count the vehicles. They can count the number of cars. And they can get a very rough idea of how many people are walking through that door. And it's an interesting extra data point for them to make better decisions, or frankly, to make fewer wrong decisions, right? But this is happening right now. This is not you can find this information on UBS, and they're not the only ones. This picture, for those of you that are in the United States, when you watch the nightly news here in the U.S., one of the things you'll hear is the price of a barrel of oil. And I'm going to assume that you're nodding in agreement. But every night on the financial markets, they talk about, on the news anyway, they talk about how much a barrel of oil costs. That oil, all the oil that's traded, or almost all the oil that's traded on the New York Mercantile Exchange, which is where that price comes from, is stored in these fields. That field you can see there of oil tanks, that's the oil field in Cushing, Oklahoma. You can drive there. It's a massive facility. Now, what's interesting about that is that structurally, those tanks, if you think about the way the ceiling works, or the roof of those tanks work, you can kind of see a picture on the right side. It's kind of fuzzy, but the point is the roof of those oil tanks floats on the top of the oil that's inside of them. And the reason why this is important is that if you are trading oil, let's say you are buying and selling stocks, for those of you that have 401ks, like retirement plans, 9 times out of 10, you have some of your money exposed to these commodities. The point is, there are companies like Genscape who will fly a helicopter over those tanks twice a week. And what they do is they then record the height of the roof. And I'm going to assume you're nodding here a little bit, because the thing is that when the roof line is going down, that means that means that oil is getting pumped into the market. And that means, if you think about supply and demand curves, when oil is getting pumped into the market, supply goes up. So generally speaking, demand goes down. And if that helicopter flies over and it sees the roof coming up, generally that might mean that oil is coming off the market, so supply is going down and demand might go up. So the point here fundamentally is, and by the way, if you ever get a chance, check out Genscape's website. They will sell you data points that are unbelievable. They will sell you amperage, power amperage numbers on pumping stations around the country, all sorts of stuff. If you think you need that data to make better decisions as a public market investor, they will sell it to you. So the point here is that not only is Wall Street doing it, but for most of you in your everyday lives, data is being used to make risk-based decisions about you already. So if you've ever had an auto loan or auto insurance or payday loans or in vitro fertilization, in any risk-based decision, data is increasingly being used against you. In fact, there's actually already starting to be lawsuits here in the United States about auto insurance providers canceling coverage because somebody might have posted a picture of a beer somewhere and then tweeted from someplace else, an hour later, and it's too far for them to have driven on their own or whatever. So, is that right or wrong? I don't really know, but the point is, though, is that because of all these social networks, because of all the geotagging that's available, things like that, there's a lot of ways that insurance companies and everybody else can make fewer wrong decisions. And it turns out in the private market that we can do it too, right? So if I don't know. Let's say, for example, I'm not convinced that your engineering team is up to par. Well, we could debate it, or I could look at your GitHub account, or whatever coding repository you use. If you use SVN or whatever else, I can look at it, right? You're starting to meet a lot of investors now that are technologically savvy. I was an engineer growing up, or coming up my career as well. If I'm trying to figure out, how competent you might be in your industry, well, I might look at LinkedIn, or I might look at what people are saying about you on Twitter. I might look at things like Alexa to kind of compare your estimated traffic against other people's traffic. The point is not that these data sources will make better decisions for me. but rather that if I take all those data sources and I add it to my gut and I add it to my expertise, that maybe I'll make fewer wrong decisions. Now here's the thing, we're already doing it, right? This is not some like future like a utopia. In fact, this is already happening. This is an abbreviated list of investors today that are increasingly using data to make decisions about you, right? And you know, you guys can look these guys up if you want, but the point is though is that some of these people will say, look, we're not even going to make a decision on whether or not to fund you unless you give us access to all your systems. I mean, that's how detailed it is now. They don't care about your deck. They don't care about anything else. They just want to see the actual data. So the point is, though, is not to scare you, but just to make sure that you understand that this is sort of becoming the new reality, is that data is important. So we've talked about startups. Now the thing is that it's important to understand that venture capital itself is a startup, and that it too needs to adapt to sort of the new world. So, and then, frankly, that's what we do. I don't want to make this about us, but if you check out some of the stuff we do with Hubble, that's our platform. It's just hubble.disruption.vc. You'll start to see how we view the world. But let's just pass that, and let's get into the meat here, which is, you know, early stage venture capital has already changed as well, right? Here's a little dirty secret. The state of the art in our industry is actually not very sophisticated today, right? And the best way I can kind of prove that to you is that, you know, you probably have all met investors that are saying that will use the words "I think" or "I feel." I think you're a good deal. I feel like you're not telling me something. The point is, though, is that like it's not very sophisticated today. And so there's opportunity there. That's not, by the way, to say that investors are dumb or anything like that. It's just that, you know, if you think about the industry for the last 50 years, venture capital anyway, we give money to founders and entrepreneurs like you, and we expect you generally to innovate, but yet we haven't, right, as an industry. And so there's opportunity there. One of the biggest changes in the venture world right now is that there's this unbundling of advice, control, and money. What I mean by that is that, you know, 5 years ago, if let's say I wrote you a check for, I don't know, let's just say $250,000, I would probably take a board seat. You would depend on me entirely for most of your money, I suppose, in this early round. And you'd also look to me for all that advice. The thing is, though, is that we're unbundling it now. So if you think about it, I don't sit on any boards right now. And many investors I know don't sit on very many boards until they have invested a lot of money into one company. So they may not actually want a board seat until the second or third round, assuming they're putting more money in. On the advice side, you know, it's unless you're asking a question about legal or finance, 9 times out of 10, a VC or an angel may not be the right person to give you that advice. In fact, they might already have a network of mentors that are vetted, that are doing that for them. But the point here is that advice, control, and money are being unbundled. It used to be that you would depend on me as your investor to give you all these things, but today, frankly, I'm just good for the money. We have a little bit of like arm's length control because while we don't sit on your board, if you know that I can give you more and more if you're doing well, I kind of have a little bit of loose control, even though it may not be legal, right? Or like it may not be on paper, but it's there. And then advice, you know, for example, with my portfolio now, it's large enough where if you ask me a question about, I don't know, Facebook ads or something, look, last time I actually did any kind of paid marketing myself was about 6 years ago when I sold my last company. That advice is not useful for you because the world's changed, but I have enough founders and other portfolio companies where I can then quickly send out an email and get you the advice you need. Maybe the better way to say it is that investors are no longer providing all the advice, control, and money. In fact, rather, we are more like the API to venture capital and functional expertise, right? We will connect to you with what you need. We can give you some money, but we can connect you with the people that can give you the advice that you need. The other big change about in the venture capital industry is that it used to be about capital or money, deal flow, and judgment. And what that means is that, you know, because remember we said earlier that it used to cost a lot more money to start a business. If you agree with that statement, well, then in order to start a business, you need a lot of money, and not a lot of people have a lot of money. And so the thing is that if I had the money back then, I would put my flag out and I'd say I've got money, and then all of a sudden I would get deal flow, right, which is all the founders and entrepreneurs talking to me, and then after that I can make my judgment calls. Today, it's really about access, right? You still need money, that's for sure, as an investor, and you still need to have like some sort of deal flow. You need to make good decisions, good judgment. But really, the difference between a good investor and a great investor, I think, is it's about access. Maybe the more blunt way to put it is that if I just put it more bluntly, and forgive me for using this language, but I would say, if I screw you as a founder, frankly, you could tell somebody else about it. And if you do, then that starts to impact my deal flow, right? And so the point is, though, is that like that's why you're starting to see more and more investors blogging. I'm sure many of you have seen this already. You're starting to see more and more investors blogging, tweeting, writing, doing conferences. They want to be accessible, but they also want to find you. They want to access you. So you forgive me for not having. Last minute I just left the Onevest logo off of here. But one of the biggest changes here is that you've got online platforms like Onevest and AngelList and some of these other ones that are driving money, connecting founders to investors. In fact, the point is you may not need to be in Silicon Valley to raise money anymore. And I'm sure Alejandro and the team can probably share some numbers eventually about what percentage of their deals are maybe across state lines and maybe even across international boundaries, right? I think we're going to see more and more of that now. But the thing is, it's increasingly about deal selection, not deal sourcing. That's the important thing for you to understand as founders and entrepreneurs, is that I'm not trying to find the best or find more entrepreneurs, right? I'm not trying to source. In the industry, you would say deal sourcing. I'm not trying to like source more founders. In fact, it's really about deal selection. And maybe the better way to say this is that for you founders and founders and entrepreneurs there, your job is not to be the best company in that I've ever seen in my life. Frankly, your job is to be the least worst company that I've seen in the sector that I care about. And that's an important thing for you to be really kind of internalize, is that I don't expect you to have all the answers, but I expect you to have, maybe more of your act together than some of the other people I might have looked at in your industry. One thing I'll just say as an aside, just as a quick note here. For those of you that don't know already, you've probably heard all these different terms: micro angel, super angel, VC, micro VC, all these things. Fundamentally, you need to understand one thing, and that is, where does the money come from? And I'll explain why this is important. If a person that you're dealing with is investing their own money, it's actually their own money, then that is, in my eyes, an angel. That is an angel. And that's important because an angel is allowed to do whatever they want with that money. Like if they like the color of your shoes, if they know your sibling, if they're even related to you, nobody cares, right? At the end of the day, an angel can do whatever they want because it's their money. Now, if the person you're dealing with is investing somebody else's money, so for example, I'm a venture capitalist, I suppose, because I've got a fund, and that fund has other people's money in it. This is important for you to know as in entrepreneurs and founders, because once you know that I'm investing other people's money through my fund, which is frankly every fund, if you ever look at a venture capital firm, that's kind of what that means. Now there's government oversight. And this is really, really important because, fundamentally the best way to put it here is that if I'm investing somebody else's money, my responsibility, my legal duty is something called fiduciary duty. And that means that it's really my job is to focus on growing that money. And so if you understand that distinction between angel and VC, this is important because when you think about deal selection, as a VC, I can't sit on that money. I have to deploy it. I have to invest, right? So you just have to be the best in the pile of companies that I've seen that week. And I know that sounds kind of strange, but we're going to talk about how to do that. Again, Hubble, we can look at that later. This, I think, is a really important thing to think about. This is sort of a checklist that I used for a long time and that we used for a long time as we invested in companies. And frankly, it's still true today, so that's why I'm showing it to you. But I think it's important for you to look at, from the investor's mind, what kind of companies are worth investing in right now, right? So for me personally, if all these boxes are not checked, I just can't do anything, right? Now, even if they are checked, I may not be able to invest, but I will want to learn more about the business. Um, so, like simple revenue models. I know that seems obvious, but I can't tell you how often people come to me and say, uh, um, oh, I think I'm going to do ads, or I'm going to do, some sort of affiliate thing or whatever, which are probably cool. Those are great models. I mean, there's other companies that have done them well, but I don't understand them. And frankly, as an investor, I don't know that I want to bet the farm on lots of traction. For those of you that have done ad-based businesses before, by the way, you'll probably be nodding in agreement with me, because like the CPM and the CPCs are not what they used to be. It's hard to build big businesses on that. I personally look for small but measurable usage. I don't need you to have $1 million a year of revenue before you come to me, but boy, I'd love to have you, showing that there's people paying you already, right? Also, that last one is really important to me personally. It's important that you have a cross-functional team, and I don't care. You could be a single founder, like a sole founder. You could have 3 co-founders. You could have a team of 7. It doesn't matter to me, as long as, from my perspective, I feel like you have the hacker, hustler, and designer. Right here, we talk about engineer, design, and all that stuff, but fundamentally, it's about having the hacker, the hustler, and the designer on there. And again, that could be mashed into one person that's just really, really good, or it could be separated out across 5 people. But for me, I just can't invest until you've got that team already set up. And I do think that more and more investors are looking for this. Primarily internet-based distribution. This is important because, remember, the costs to start that business are coming down. The web is getting bigger. The world's smaller. You can actually use the internet to get to customers. But if you're trying to scale on people, meaning you need a sales force that has boots on the ground walking door to door, it's not a bad business. It just gets a little bit more expensive than I might have money for. Now, that leads into what I think are sort of the new reality of financings today. Term sheets are pretty much standardized today. And even if they're not standardized, at least they're public. And I'm going to give you some book recommendations at the end to learn about term sheets. But the point is, though, is that as long as you're dealing with a reputable investor, again, as long as you're, let's say, as Alejandro mentioned earlier, it's, they're vetting the angels on there, they're vetting the investors on there. Generally speaking, as a founder and entrepreneur, you still have to cover your butt, but generally, these people are going to just use standardized terms. There's fewer fixed amounts. There's fewer single closings. At the earliest stage, there's still fewer lead investors than ever. We're seeing rounds that are continuing forever. We're seeing prices that go up. You might get in on a valuation that is $1 million a week ago, but then that valuation could be $10 million next week because so many investors are interested in that company. No board seats at the early stage, and herd mentality. Maybe the thing to think about as a founder and entrepreneur listening to this is that last bullet point there is the important one. Is that you have probably asked an investor, hey, are you waiting for somebody else to make a decision? And 9 times out of 10, the investor will say no. They'll say no, I make my own decisions. The reality is, herd mentality exists. You don't have to agree. You don't have to even get them to agree. But that means that there is this real phenomenon where human behavior. If I see somebody else doing something, I'm more inclined to do it myself. So just know that herd mentality and oversubscriptions are real. So I think as investors, what we're seeing is that first checks should be small and fast. And we're seeing more and more people doing that. But that also means that strategy does not work as an investor unless you double down heavy if the company survives. Meaning, I'll gladly give you, what I used to do is I used to give you $50K, and if things were working really well, I'll dump another $250,000 to $500,000 into the business and keep it going. Today, we kind of write a slightly bigger first check. It's about $250,000. But if the company's doing well, we might dump, up to another $1 million in the next round. The point is, though, is that first check doesn't need to be a $5 million check. Not always, anyway. So I think investors are starting to really understand in the private market that risk and uncertainty are not the same. But here's what I really want you to understand about the business of venture capital. The business is really about choosing the least worst opportunity that's available to you, right? So the thing is that in a world where I can't predict who the next Google, the next Facebook, or the next LinkedIn is going to be, My job is just to try to make fewer wrong decisions. And the better way to handle that, the better way to deal with that is to, or adapt to that, is to use data and to have small checks out there. So that's good. So anyway, private market, that's all you guys, startups and entrepreneurs. The private market's becoming more accessible. It's becoming more transparent. You know, these are a bunch of available websites, and these are not comprehensive, but like you can actually look at salaries. You can look at like what Chris Dixon is saying. You can see sample pitch decks from 500 startups. The point is, if I can be very blunt here to the founders and entrepreneurs, there is very little excuse today for having a shitty pitch. There's very little excuse for not knowing what a term sheet looks like. There's very little excuse for not having access to the investors you want to meet. And so then the private market's becoming more efficient. I mean, I'm sure at some point, you know, when we look at some of these online platforms and the data they release, I bet what we're going to see is that the time to fund is getting shorter and shorter. Right? It might have taken you 6 months to raise $500,000, you know, 5 years ago. I'm making this up, but if that's true, then it might only take you a month to do that today. So it's just becoming much more efficient. So the key takeaways, and this is going to seem overly obvious to you, but not enough people internalize this. If you're an entrepreneur or a founder today, two things. Number one, you must focus on traction. You must focus on traction. You know, that's what's going to separate you from the crowd, right? Like there's hundreds of people on this call, right? You're all competing generally for a finite pool of money. And in that world, the only way to win, I believe, is these two things. You got to focus on traction, and you must learn to communicate and inspire. That second one, nobody ever talks about, but I think is so important, especially for you, those of you that are founders. But also it applies to the entrepreneurs there and all that. I think the point is, though, is that if you can't communicate and you can't inspire, for example, me to want to invest in your company, that's not the end of the world, but you should at least ask yourself the question, will you be able to communicate and inspire your next employee to join you? Will you be able to communicate and inspire that journalist to write something about you? Will you be able to communicate and inspire your team to go do great things? If I can make a personal suggestion here, I would say invest in your own charisma. Invest in your own charisma. There's a book, you can get it on Amazon or wherever your local bookstore, but it's called The Charisma Myth by Olivia Cavane. It's called The Charisma Myth. It's like $10, maybe $15. I'd really encourage you to read it, especially if you, regardless of whether you're going to like raise money or you're going to stay in your day job or whatever. It's important that you take a look at that book, and it'll seem so obvious to you. But I think charisma is not innate. I believe it's learned. And I'll just say as an aside, I didn't do any public speaking until about 3 years ago, and I think it's I've had to invest a lot of this stuff. I've had to do the stuff that I'm encouraging you to do. So last stuff here. I think it's important for you to understand that distribution is more important than your product, right? Like that's not to say that your product's not important, but rather that like if you want to raise money from the outside, whether it's me, an angel, or somebody else, you must understand that like the product is table stakes. You know, just to use a gambling analogy, the product is table stakes, and the distribution model, that's what's going to make the difference, right? How are you going to get from 10 customers that you might have to 1,000? That's going to make the difference. It's not going to be a better banner on the top of your website or better menu. Not always, anyway. The second thing is obviously same token here. Strategy is nice to have, but frankly, the tactics are very important, right? Again, just like above, it doesn't mean you shouldn't have a strategy. It just means that you should focus more on really the tactics. This third one, I think, is the most important thing for you to understand, is that credibility is just table stakes. It's notability that's really important. That's how you're going to like stand out of the crowd. So let's just look at what we're doing here, like what I'm doing here with Alejandro, right? We are both probably credible, right? You would think that we've both done our homework and we know enough to be credible. But in a world where there's a lot of investors, a lot of angels, a lot of these things, credibility is not what's going to make us stand out. What it is notability. And so what this means for you as founders and entrepreneurs is that if you plan to break into a certain industry, not only do you have to figure out how to be credible in that industry, but you must figure out how to become notable. The best hack to this, by the way, maybe it's not a hack anymore because a lot of people do it, but think about public speaking, right? Think about getting on stage once a month somewhere on the planet in the industry that you plan to break into, right? So if you're selling widgets to the auto manufacturers or whatever you're doing, you should be on a stage somewhere on the planet getting better about public speaking, getting your name out there, getting your company's name out there. I should say, again, I apologize here. It says get on AngelList. I should say get on AngelList and Onevest. Get on all these platforms. Like, you need to get out there. Even if you don't end up raising money, it's important for you to know what else you're up against, right? Because that's important. For at the very least, as a founder or as an entrepreneur, you need to know what you're up against. And getting on these platforms is a great way to start to see what else is out there, and so that you know what you're fighting against. The next thing is that you want to raise at least a year of financing. I think the reality is that fundraising is hard, and I think that some people will end up raising money and then come out of it only having like 6 months of cash in the bank. Next thing you know, they haven't even had enough time to build the product, and they're fundraising again. So just try to raise at least a year, ideally a year and a half. It is hard to raise more than a year and a half of money, but it's at least trying. You should learn venture capital economics. On that previous slide that I had, there was some stuff there on that, or URLs or links to that. But if you don't understand how an angel makes money on the deal, that's a bad thing, right? So you should learn VC economics. It's pretty simple, believe it or not. It's pretty simple, not rocket science, but check it out. And I think for any of you that are investors in the audience, I think it's important to understand that you don't want to confuse due diligence with progress and probability. In the earliest days, companies don't know what they don't know. They might pivot, they might turn into something else completely. That doesn't mean you shouldn't do due diligence. You should check your paperwork, make sure that it's legit, make sure they've filed everything and all that. But you need to know that really most of your decision making at the beginning is going to be about progress and probability. And data can help you with that, but it's really about progress and probability. And then my little shameless plug is that's where we come in, right? And we can help you with that.
Unmuted.
So I'm happy to help you. I didn't put my email in here, but it's just paul@disruption.vc. I'm happy to help any of you on the call any way I can, but I only have one requirement, and that is that if you email me, I ask that you be very crisp about what you're asking. And I'll try my best to answer for you. I know I went a little bit long here, Alejandro, but I'm happy to take any questions and answer them for you.
No problem at all. Thank you so much, Paul, for the wonderful points that you were addressing here. Without a doubt, the slide that I like the most, and I'm sure that many of the people here were relating to a certain degree, was to be able to communicate and inspire. I think that there's not a lot of people that in the startup ecosystem that are really mentioning these two key ingredients, because I think that you need to inspire and you need to communicate with your employees, with your investors, with your advisors, and then also with press, how you get the word out there, how you tell your story. I think that that's very important. So I think that without further ado, why don't we take a couple of questions? I have actually here Nathaniel, my colleague, who is going to be reading out loud the questions that are coming in for you, Paul. So
okay.
Nate, whenever you're ready, please feel free to shoot over some of the questions. By the way, the questions, you can type them in here on your GoToWebinar control panel. Just type it in there, and we will be receiving it on our end, and Nathaniel will be reading it out loud, the questions that you may have.
Muted.
Hey, Paul, as Alejandro said, thanks so much.
Muted.
Alejandro said, thanks so much for taking the time to, speak to us and everything, and we're going to go ahead and get right into the Q&A. I have a question here from Alfredo on the line, who wants to know the typical method that you usually use to make startup valuations. Do you usually use traditional methods such as DCF, the discounted cash flows, or is that kind of irrelevant toward evaluating startups? And if you could just speak to that, that would be great.
Well, so I will tell you, I don't use DCF or anything like that at the earliest stage, primarily because a lot of these companies don't have stable cash flows for you to. So now, forgive me. This is I'm not I'm not too well versed in this, but I would just say that like DCF calculations and things like that work really well if you've got a linear path or you've got some sort of like amount of history that you can use to predict what the future might look like. The fundamental challenge of tech companies, and frankly the reason why I invest in tech companies, is that they have this ability to either go up really fast or go down really fast. So let me say it a much more blunt way. I invest in the private market. I invest in startups because I believe there's no better way in this country or in this time, in this world, to make lots of money. And I think that's true for founders, for investors as well. So you could do DCF and things like that for later stage companies. So I think when they've got $1 million a year of gross revenue and maybe a year of history, you may be able to do that. But it's very hard, and I would argue not even useful to do that for a company that's less than 6 months old and may not have any revenue at all. And I also say, like, typically, like, there's a lot of services out there now that will issue or show you what the average valuations are, right? I mean, generally speaking, early stage valuations feel like they are at the $2 to $3 million mark, and then they kind of go up from there. But it just depends on what the market's willing to bear and how fast the company is growing itself.
Thanks, Paul, for the answer. I have another question here from Tim, who owns a startup in Europe. They'd actually meet all of the criteria for the 500 checklist that you go over. They already had B2B clients, recognition, and international traction. So Tim wants to know, from your point of view, when is the right time to come into the US and raise money for a Series A round or a similar amount of funding?
Well, I don't know that there's any right time. I mean, I think, look, if you've built a revenue, if you've bootstrapped to where you want to be, why raise money? I mean, so look, I know that the point is it's not a simple answer. I mean, the irony here is that I invest in other people, but I bootstrapped my companies. You've got to. I think the important thing I think it was Tim you mentioned there. So Tim, I think you have to decide, or at least before you make the decision on when you want to come and start raising more money and all that stuff, two things are true. Number one, before you ever decide to raise money, you must decide and be okay with the fact that by accepting somebody else's money, you are agreeing to sell the company at some point in the future. Maybe there's other ways to keep the company private, but generally speaking, you are committing to selling the company, and that's something you just have to decide if you're okay with. The second thing I would just say is that, like, we as an industry, all of us, and this is more to everybody on the call, and I'm just gonna say it mostly to everybody on the call, but I'll call you out for it, Tim, is that, look, I believe that the word startup is Hollywoodized, right? And I'll tell you right now, I don't invest in startups anymore. I don't do any of that stuff. You're either a high-growth tech-enabled business or you're nothing. I think a startup is somebody that has no revenue, which is fine, but let's just define it as startup is somebody that has just actually started up. Like Uber is not a startup. From what I understand, Tim's company is not a startup. The minute you get your first revenue, you are no longer a startup. You're a high-growth tech-enabled business. And I know this doesn't sound like it's important, but this is the reason I believe why our industry doesn't get a lot of credit outside of it, right? So, like, there's a reason why, like, tech is not sexy in different industries, different places just yet. So anyway, before I go too far down that rabbit hole, I'll just say, Tim, you're not a startup. Don't even call yourself a startup, and that's okay, right? You're a fast-growing business. Totally cool.
Hey, Paul, thanks a lot for that answer. So just a quick note, we're here at 2 p.m. Did you have a hard stop here, or do you mind staying on the line for maybe 2 or 3 more questions?
It is cake. I probably have a hard stop around 2:15, so about 15 minutes from now, but yeah, I can do that. Happy to do that.
Okay, great. So I have a question from another Tim here who wants to, you to elaborate on speaking via raising under convertible notes or strict equity. Do you find that one is easier to attract angels or so forth? And if you could just speak to that a little bit.
Well, if we're asking from the perspective of the founder, from the perspective of the from a founder's perspective, a convertible note tends to be faster. Now, these are broad general statements, right? So from a founder's perspective, a convertible note tends to be the fastest way to go because you don't need to, get everybody around the closing table together. The terms are simpler. It's pretty fast. Now, there are pros to that, but there's also cons to that as well. From the investor's standpoint, convertible notes aren't bad, but equity is preferred. So that's sort of the big general strokes or broad strokes. I would say from my perspective, I'm completely comfortable doing either. Generally speaking, though, convertible notes for me feel a bit better when you are pre-revenue, or maybe even you just got a little bit of revenue. It may just be better to just keep your legal fees low because, again, I think everybody will tell you something different here, but I just think that whenever you cross the line and get into equity-based deals, just for whatever reason, the legal costs go up, the complexity of the deal goes up, and for an early-stage company, just try to avoid that. You will have to do it eventually, but if you're raising your first round, I would lean towards convertible notes until you have an investor that says, I'm ready to do the deal, but only if you do it as equity. So, yeah, that's how I would look at it.
Great, thanks, Paul. So you mentioned that investors have a herd mentality. So what have you seen from your experience or from others' experienced as the biggest catalyst for getting that first investor to invest?
Yeah, I mean, I think so. I think of in my head, I'm just maybe a little bit more visual than I need to be, but in my head, I think of fundraising is like a set of dominoes, right? And getting that first domino to fall can be the hardest one, but then once that falls, it gets a lot easier to push all the other ones down. So whenever I think about fundraising, I think the key is you don't want to go out to the full market and be you don't want everybody to know you're fundraising. I think one of the hacks to fundraising is to think about it in terms of concentric rings, right? So when you decide to fundraise, who are the first 10 people that you think know you the best, like you the most, and really are advocates of whatever you're building? Those 10, maybe only one of them invests, but you want to focus all your efforts on them, and frankly, only they should know you're investing. The minute you lock up one or two or maybe even more, then you open it up a little bit. Maybe you pick the next 25 people you know. And so the point is that to answer your question specifically, when you first start fundraising, it's not usually a good idea, I don't think, to just go out to the market and say, hey, everybody, I'm fundraising. Instead, you should be investing in, or you should be focusing on the investors that like you the most, like your product the most, and really align with your vision. And this is sort of an unspoken thing, but I think founders should be, you have to find some balance between building your business and building the relationships that might grow your business eventually. So that means that if you think that there's a remote possibility that you might be fundraising in 6 months, you should probably start setting up casual coffee meetings now, once a month or something like that, and don't pitch. You're just trying to get to know them. What do they like investing in? What's their favorite deal so far? What's a common mistake a founder makes? You're just trying to get to know them, and then 6 months from now, maybe you've learned enough about them where you're like, oh, I don't like this person, I don't want them in my deal. Or you might say, you know what, I've learned enough, and hey, by the way, here, let me show you what I'm working on. What do you think? Right? So
Unmuted.
first person to fall is hardest, or fall is not the right word, but that first person in is the hardest, but you've got to invest time, and you've got to have traction in there. You've got to have a relationship there.
I would actually really quickly have to agree with you, Paul, on that note. The first checks are the toughest ones, and also the most important ones, because that's how you're going to be creating the context for the offering, that you're putting out there to the world once it's time to open the round and to get other investors. So I would have to agree that it is important to first get to know the investor, also to try to get some feedback to see what's the mentality, how that person can add value to what you're doing. And then once you get those first checks in the door, then it's time to perhaps go all out and fill the rest of the round.
That's right.
Great, thanks. So in respect of time here, we are just going to open the floor for 2 more questions, and then we're going to go ahead and start to end the webinar. So Paul, to kind of build onto that a little bit, we have a question from Nick. He wants to know, in your perspective, don't you think investors might get tired of so many entrepreneurs wanting to, quote, build a relationship?
Well, so here's the thing. So maybe, but they won't be in this industry very long. That's for sure. Um, I think, but that phenomenon is real. I mean, look, there's only so many coffee meetings that anybody can have on a particular day, and so now that I've told you guys this strategy, all 100 plus or 200 plus of you guys are going to be like using that strategy. That's going to be hard. So you know, the thing to think about is you don't necessarily, if you can avoid it, you don't want to cold email somebody. You want to come in through a warm introduction. So that means that, like, if you know that I've invested in somebody, so let's just use me. You could certainly cold email me, and I'm going to try to like fit you in if I can. And frankly, like I'm only going to drink 1 cup of coffee a day. Otherwise, I just bounce off the wall. So it might be scheduled out a long time from now. But it'll happen, and I'll try my best. And you can't be in this industry unless you're like getting to know a lot of people. But the faster way to get in is, in my case, for example, there's probably hundreds of founders out there right now that I've funded. You should probably be building a relationship with them, and that doesn't mean you should say, "Hey, Paul gave you money. You should introduce me to Paul," because they know that their job is to like kind of be a filter, right? There's this concept of social capital, right? So what you really need to be doing is, like, if you think you're going to be raising money 6 months from now, the first thing you should be doing is start making friends with venture funded or funded founders and funded teams, and genuinely try to help them, genuinely try to build that relationship, because at some point you're then able to say, hey, I have this question. I think Paul's the guy to ask it. Would you mind hooking me up with him? And as long as they don't think you're creepy, they don't think you're like just using them or whatever, they're going to make that intro. And when I see an email from somebody that I've funded, I'm much more likely to pick it up much faster, much more likely to prioritize it and move everything else to make sure it happens. Maybe the flip side of this is that if you ever run into an investor that is just treating you poorly, poor social skills, whatever, I would actually run the other way. I would. You don't want to be like that's. Like, this is going to sound awful, right? So please don't take it the wrong way. But the interesting thing for you all to understand is that it's once you've raised money from an investor, it is easier to get divorced from your spouse than to get rid of an investor. And that, I feel like a jerk for even saying that, but like getting rid of an investor is almost impossible. Whereas, like, even though, like, when you think about it, even the concept of divorce, that might be awful, but like at least it's got a process. Right, and there's a legal process, and like you're not hurt after that. But the point is, be careful. Like, it could be that if they really don't like meeting people, that there's worse signs there. That there's worse underneath the covers there, and I'd just be really careful. By the way, one other thing I should say is, like, try not to be anybody's first check. Don't so it's okay if let's say somebody's making their first investment, like as an investor. Let's say they're making their first investment through a platform like Onevest. That's probably okay because Onevest will, vet them and things like that. But when you think about who you are going to raise money from, I would focus on people that have done at least one deal, if not a couple of deals, because like those are the people that are more likely to write a check anyway, right? That first check is just, it's not, statistically speaking anyway, being somebody's first check, I think, is like a very risky thing for a founder.
Great, thanks, Paul. And then we're just going to go ahead and take one last question here. Do you have any case studies that you could quickly talk about that have met the 500 checklist that you could share for everybody on the line?
I'm not sure I understand the question.
Companies that you've been working with that have met the 500 checklist that you went over previously. If you could just share a quick amount about them and why they did meet that criteria on the checklist.
Well, I mean, it's tricky, right? Because like if you look across all the portfolios, the entire portfolio across all the funds that I've, I guess, been involved in, we're probably now at north of 900 companies. So it's hard for me to pick one and say, look at it. I mean, I don't know. You look at the most recent deal we closed a couple days. Well, I don't know if that was public yet. So I don't know. Like let's think about, I don't know, ZipDial. So ZipDial was a company in India that just got acquired by Twitter yesterday, I believe, or the day before. So ZipDial, right? They do like missed call. It's a missed call service in India, which is like a big thing culturally there, and it's a pretty lucrative model. And you know, you look at that company. I got to know the founder over time. I had met her multiple times at different conferences, and every time I met her, it seemed like, you know, the initial checklist was easy, right? Like, oh, I'm like, oh, I understand the business model. Wow, you have some revenue. Wow, the team seems really cool, right? Once that's all done, every time I kept seeing her, I'm like, hey, how's the business going? We have coffee somewhere in, you know, Bangalore or wherever. You know, every time I'd meet her, you know, I'd ask her how the update was going, and it just felt like the business was always moving forward. Always felt like the business was moving forward, even though at that time I didn't know the revenue numbers or anything. Like, we didn't have that good of a relationship at that point where she's telling me exact numbers. But the point is, though, is that every time I would meet her, conceptually, it felt like the business was moving forward. How can I not invest in that? And so I could probably give you lots of examples like that. But you know, that's the important. Maybe that's the lesson to be taken from that, though, is that the media will have you believe that you know, if you're going to raise money, you should jump on a table, kick a stapler, and then somebody's going to write you a big check, and that's going to happen in 2 days. The reality is, it's a long series of weeks and months. It's a lot of work, building relationships and getting to know people, and while keeping your business going. But it's an art. It's more of an art than a science. But it's important to understand that the first meeting, the goal of the first meeting is to get the second meeting. The goal of the second meeting is to get the third meeting. And then it's only after the third meeting that I think you should make any kind of ask, right? So, like, that's maybe my personal advice to all of you in the audience, is just that, remember, the goal of the first meeting, you don't want to like meet them, say hello, ask about their families, and then ask for something else right away. That doesn't really end well usually. So just keep the door open for the next meetings.
Alrighty, Paul. Well, thank you so much. Thank you so very much. It was an honor to have you here. We've been getting incredible feedback from the crowd. I mean, one person just said, "Great quote. Getting a divorce is easier than getting a divorce is easier than getting rid of an investor." So
I think I'm going to get in trouble for that. But okay.
Yeah, you never know. But thank you so much, Paul. It was lovely to have you here. I'm sure that the founders were very, very excited with all the advice that they have received, and thank you. Thank you so much.
My pleasure. Thank you all. Have a good day.
So we are going to right now move here to wrap up the webinar. And just really quickly, I just wanted to let you all know that we're going to be hosting a couple events that are upcoming. They're all obviously for accredited investors. One is an intimate webinar discussion with one of the companies that is on the Onevest platform, which is called SpeechTrans, which they are developing live translation. And then also we're going to be hosting a digital demo day where we have online companies pitching their business live, and they're all VC-backed companies in the healthcare and also the consumer product industry. So with that being said, thank you all so much for participating in this. But before we do that, please click on the poll that we're launching right now if you would like to participate on any of these two, and if the answer is yes to one or yes to both, we would be reaching out with further information. So let's just give 2 seconds here. You will see the poll right now launching on your computer. And while we are completing here, after this, we're going to be wrapping up. Let's see, gathering your responses. Please click whether you would like to participate in one or in both, or in maybe you don't want to participate in any of them. So we will obviously not contact you. So let's see here, 5, 4, 3, 2, 1. Wonderful. All righty. Well, we're closing the poll here on our end. Thank you all very, very much for participating in this webinar session with Paul Singh. It was a pleasure to have you all. And as always, without you, we wouldn't be here. So thank you so much. Take care, everyone, and have a great rest of the week. Bye-bye.